This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Tim Koller. He is a partner at McKinsey Company, one of the biggest consultants in the world. He's a core leader in their strategy and corporate finance practice. He also happens to be the author of a book called Valuation, Measuring and Managing the Value of Companies, 7th edition. The original edition, I believe, 1990. Tim's been at this for a long time. And for anyone who knows something about my background, valuation, measuring company value, the exact opposite of my world. But as you know on this podcast, I want to bring on the diverse voices. I want to push myself. I want to push guests. I want to have that conversation. I want to dig into it. And there can be no doubt that Tim and his co-authors have put the work in. This book, Valuation, 896 pages. They definitely turned over all stones to put this book together. Without any further delay, let's jump right in and cover all the issues around valuation and everything else that's going on in the world of economics and finance today. I hope you enjoy this conversation with Tim Koller. I'd like to just start with something big picture before we even get into the content, because here you are, you're in an interesting catbird seat at a very large consulting firm, very well known. And here we are in this, there can't be any more of a crazy, wild, weird year when it comes to politics, economics, business, the Fed, you name it. When you sit around with your associates and you guys are trying to wrap your arms around everything, what have been some of the big picture issues and concerns that y'all have when you look at the landscape right now?
First off, let me say that we don't know, and I don't think anyone knows, the shape of this recession and recovery and the timing of it. No one really knows that. We think that the uncertainty is something that managers have to be particularly thoughtful of and planning accordingly. What that means to us is that, well, first of all, there are some companies that are just in survival mode. They have to do everything they can to conserve cash to try to get through this period of time. There are other companies, though, who can make it through without too much difficulty. And they should be thinking about the health of the business over the longer term, because we eventually will get back to something more normal. There will be things that are different. People may not work in the office every single day, or whatever, but the basic products and services and those kinds of things will continue on. Companies that have enough liquidity to weather a very difficult year, maybe a little longer, should be planning on protecting their reputation with their employees, with their customers, and their suppliers. Because if you destroy that reputation, it's very hard to get it back. You want to come out of the recovery as quickly as possible. And the better shape you are, the better shape your suppliers and customers, and the better relations with your employees, the more likely you're able to recover more quickly when the economy does turn back up.
You use the word eventual in there. I've noticed in my conversations with associates, we get to the middle of 2020, where we're having this conversation today, July 2020. I'm noticing that people are already wiping away the rest of the year. People are like, okay, there's not going to be any travel till 2021. In my mind, I start to say, well, gosh, if you can wipe away 6 months, why can't you wipe away 18 months or even longer? So what does the word eventual mean to you?
The word eventual to me, we don't know for sure, but if you make the assumption that within a year from now, 18 months in total maybe, that there is some kind of vaccines, other things, and there's a lot of people with immunity, et cetera, I think a lot of people think that we will get back to heading back to normal in that period of time. Question is, how long does it take the economy to begin to recover? I think people have very different opinions on that, and nobody knows. Depends on how damaged things are. We're going to end up with a situation where there's going to be a ton of government debt, unprecedented amounts of government debt, for example. Lots of distortions in the way people have been spending money, lots of businesses that will have gone bankrupt. What that recovery will look like is very unknown because this is unlike other recessions that we've seen, at least that I've seen in the last 50 years or so, 50 or 60 years, because it's not a kind of recession that's caused by an imbalance in the economy where one sector got overheated. Like in the last one, it was the real estate sector that distorted things, and other businesses were not so bad off. Here, you've got a situation where you've got lots of businesses, particularly small businesses, restaurants and small retail stores, a lot of apparel retailers that probably won't make it through. So you'll have a lot more bankruptcies, a lot of businesses going out of business. It takes more time to get those things turned around and get things going again. There's tremendous uncertainty. I tend to look at things from a longer term perspective, though. 3 to 4 years, I think we'll be back closer to normal, but it could be a messy period of time between now and then.
You mentioned government debt. And again, before we jump into some valuation discussion and break that all apart, but you mentioned government debt. We're looking at a situation essentially for this run up from March of 09 until early in 2020. We have, I would argue, artificially depressed interest rates. Now, we really don't have any interest rates. We've got an entire baby boom generation with cash in the bank where they otherwise would have thought in prior decades we're going to get some interest income going forward. And so here we have all this situation of government debt. We have interest rates at a 0 point. Boy, it sure seems like the addiction to the government backstop is going to really be tough to break.
I think that's one of our biggest concerns, is that very question. What is interesting is that, on a sort of side note, does provide some comfort. The stock market, the way investors have been valuing companies, the cost of capital that they've been applying or the expected returns has not gone down over the last 10 or 15 years as interest rates have come down. Companies are still expecting to earn the same kind of returns that they earned before the decline in government bond rates. This is really a government bond market, corporate bond market phenomenon. It hasn't affected the valuations of companies. If it did, you'd expect to see the typical company, even before the coronavirus, with price earnings ratios well above 25 instead of in the high teens. Whether the market was a little bit overvalued or not is debatable, but it's not by a major amount. What that tells us is that when we do the math in different ways and talk to companies and talk to investors, they're still investing on the basis of prices being low enough of stocks that they can earn a 9% or so return going forward. That's one piece of good news, is that the stock market itself hasn't fallen into that trap. Part of that is because you can't lock in the cost of equity, if you will. And when it does change, you don't want to be caught, and companies don't want to be caught either, making investments at a very low return on capital, only to find out that interest rates and cost of equity goes up later on. Everyone's being very cautious in the corporate world. In the debt world, on the other hand, it's a very different situation. You do have the situation where the primary beneficiaries of the low interest rates have not been businesses. The primary beneficiaries have been the governments themselves, who could borrow at these low rates, and to some extent, the real estate industry, allowing people to take on mortgages at lower rates and stuff like that. These imbalances have to get fixed. Most economists, even at the Fed, will argue that eventually interest rates have to get back up to something normal because you have this imbalance. As you mentioned right now, the baby boomer generation isn't earning anything on their money. The savers are really at a disadvantage in this environment. That can't be sustainable. You can't have a situation where, particularly as you get older, a young person can put most of their portfolio in stocks. As you get older, you do need to have some fixed income instruments in your portfolio. And if you're earning less than 1%, very difficult for you to do any savings or to draw down your savings in a reasonable way. The impact on savers, particularly older savers, is simply not sustainable. Somehow this has to break. Most economists don't know how it will break, but they think it will break and will some point get back to something more normal.
I got to press you a little bit there because you use the word eventual and you say some point. I'm looking at essentially just to round up the last decade of a ZIRP policy, zero interest rate policy. What does, you get a chance to talk to a lot of interesting people behind the scenes. I'm not asking for names, but what does eventual look like when it comes to interest rates? Because I got to figure, I mentioned the baby boomers, but let's talk about these younger generations. These younger generations are not going on to Robinhood to trade or doing anything in their life with the idea that they're ever going to have interest income. It's got to be a foreign concept to them.
That is true. Not spending all my time in the realm of macroeconomics. It's interesting that economists keep on saying it's only a couple years away before interest rates get back to normal. We will soon be in a situation where when we come out of this, the government debt will be so high, the Fed will not be able to continue to buy securities and push interest rates down. This is all driven by the central banks pushing interest rates down by buying securities, things that they never did before. And eventually they're going to have to unwind their balance sheets. With all this government debt, also, we're going to have to figure out, okay, well, how do we deal with inflation? Inflation could lead to higher interest rates as well. There's a whole bunch of things that suggest that eventually this has to get back to normal. When the eventually occurs, I don't know. Prior to the coronavirus, I'm surprised that we had 10 years of such low interest rates. I think most economists were. This is going to prolong it. Fed had started to sort of unwind things that might have led to more normal interest rates. I think this will delay it. Who knows how long? It could be 3 to 5 more years before we start getting back to normal. But that is pure speculation.
Yeah, I just kind of wanted to warm our conversation up with a little bit of current stuff going on. Let me take you back in time, though. The first edition of your book, Valuation, is it 1990?
1990, that's correct.
I had a first book come out in 2004. That feels like a long time ago. It's got to be quite interesting to look over that time period. Before I start to dive you into some of your thinking and your process and whatnot, because obviously I spent a lot of time writing books that often might be positioned as the polar opposite of your books, this momentum style trading. But take me back in time to 1990, the lead up to putting something like that together. Put me in some of the headspace that you were in, a little bit more of a more normal time then. We were coming off the 87 stock crash. What was going on in your world, the inspirations, the influences for that first edition?
Interestingly, the book actually didn't start out as a book. We never actually intended to write a book. At that time in the late 80s, 87, 88, 89, we had the equivalent of what we now call activist investors. Remember, we used to call them raiders back then, corporate raiders, who were doing hostile takeovers of companies. They were raising big questions about what a company should be worth, how could these raiders make money, buying these companies at high prices, et cetera. When we looked around, we wanted to make sure that valuation and value creation at the time, which had not been a big topic, was a core part of the strategic analysis and work that we did with clients. What we did is we actually wrote just a 3-ring binder, which was for McKinsey consultants, on how to do valuation, how to be very practical about sort of what drives value, how to actually convert income statements, balance sheets, et cetera, into the cash flows that you could discount, what were the drivers of value, et cetera, so we could educate ourselves and our colleagues about how to do this so that we could do a better job adding a value creation component to our strategy work. That's how this all started. And it started, as I said, because back then there was a lot of activity of hostile takeovers. It was getting people excited, and we felt we needed to be able to know more about what was going on. Someone at the time then, I don't remember who, suggested that we show that 3-ring binder to some publishers, and they liked it. We turned it into a real book back then. That's what was going on back then. There was a lot of interest in valuation because of the activity of the corporate raiders. At the time, also, there was in the academic world a push towards pushing management incentives more tied to stock price performance. More and more companies were interested in sort of how their companies were valued and those kinds of things. That's what some of the impetus was for publishing it in 1990.
Going back, or staying back in time for a moment, were there any individuals behind the scenes that you had a chance to access in those early stages? I'm sure there were, that stuck with you. I mean, obviously, everyone can think when they think of valuation, they can think of someone like Mr. Buffett. Were there any inspirations behind the scenes that you got to have this firsthand contact with that was driving some of your work and research?
Most of the people we had contact with were senior executives, CEOs of companies who were wondering what was going on. Were they vulnerable? And how should they be thinking about it? So that was to some extent the impetus of it. We did have some contact with some of the corporate raters back there, so we understood how they were thinking about it. But most of it was sort of from the confusion or curiosity of the senior executives wondering, okay, could this happen to me and what should I be doing differently as a result of this?
Are we going to be the next Boone Pickens, Mike Milken funded takeover?
Exactly.
That kind of concern.
That's exactly what the concern was.
Yeah. Well, it must have been terrifying in a sense because you have so many long-standing, and I remember all those books back in the day, Den of Thieves, Predator's Ball, etc., Barbarians at the Gate. I remember thinking when I first read all those, I was like, wow, this is so fascinating. All these long-standing companies, they've built these reputations, these brands, all this customer base. These guys just come in through this interesting financing mechanism. Boom, they take them over. RJR, it was crazy.
Yes, it was crazy on the one hand, but on the other hand, many of the targets were legitimate targets in the sense that they had become bloated, if you will, or they were in businesses, they were too diversified and couldn't run their businesses well. If you're a diversified company, each business has to be a top performer. Diversification isn't good for diversification's sake, according to investors. If you didn't have a top performing companies, or if you had too much corporate overhead or too much costs, even if you were performing well, it was a big opportunity. So in many cases, it wasn't that hard. And what we would often do is work with companies. We would do it both an outside diagnostic and an inside diagnostic to say, boy, look at all these things you could do to create more value. Look at where your margins are lower than your peers in this segment. You've got all these excess costs over here. You're not growing as fast as your peers in this segment. You got to fix these things or get rid of those businesses because you are vulnerable and there's no justification for you to be a mediocre performer. Just because you're big and you got great brand names or whatever doesn't mean you can't tightly manage your business.
KKR understood value better than the CEOs.
In a lot of ways, them and the other buyout firms really did understand that, and they understood the better firms are not just slash and burn. The better firms would go in, and as today, the private equity firms, the better firms go in and figure out, well, what costs can be cut that are really just waste? And where do we need to invest? Obviously, sometimes companies are spread too thin, so they need to divest businesses, but also they need to build businesses sometimes. The best private equity firms now will often help companies invest in building parts of their businesses. We're recently I have a colleague who's writing an article. He's done a lot of work with CEOs of private equity owned firms and comparing it to sort of what it was like when they were public. The reality of it is they say we can do things as a private equity firm that we didn't feel we could do as a public firm. Whether that was true or not is a different issue. But with a 5-year horizon, what happens to our numbers in the next year or two isn't so important to the private equity firms as long as we're moving in the direction. Whereas they felt that each year sort of had to stand alone on its own. And so they couldn't make bigger moves, both investment wise, cost cutting wise, restructuring wise, as a public company.
You've got several very strong messages in your work. I think one of the key messages, though, and it's an interesting one today because I'm seeing a lot of pushback on it. Companies thrive when they create economic value for shareholders. I am starting to see an influx of books and potential podcast guests where there's a significant part of the population, business world, et cetera, that don't like that statement. They don't like the notion that a company thrives when they create economic value for shareholders. They're starting to expand this to stakeholders and other kind of ambiguous type individuals and operations involved. Maybe they don't even own shares. It seems like the burden of being a public company today could be argued as changing.
We've thought about that a lot. Even in the very first edition back in 1990, we argued that when we talked about value creation, we talked about value creation over the longer term. There are plenty of things companies can do to make their results look good in the short term and maybe get a bump up in the share price. But you should be thinking about your shareholders as not today's shareholders, but all the shareholders that you're going to have over the next 5 to 10 years. You should be thinking as an executive, what can I do to maximize the value of the company over the next 10 years? Often that means if I'm going to grow effectively, if I'm going to be successful over a 10-year period, I have to have a good workforce, a satisfied workforce, a productive workforce, a workforce that's excited about what they're doing, that likes to work for the company. I have to have customers that are pleased with what we're providing them. I have to have good relationships with suppliers. And in some cases, I also have to have good relationships with regulators. I can't take shortcuts with safety because that almost always comes back to haunt you. And I do have to worry about the risks of environmental change and regulation and those kinds of things. Our view is that those things are not inconsistent with long-term value creation. They may be inconsistent with, like I said, I can do things because investors can't see all the little details that are going on inside a company. For a couple of years, I could make my profits look better by shortchanging some of these other constituents, and I might get a short-term boost in my share price. But if I'm focused on the longer term and shareholders over time, not who some of the traders are today who want me to maximize the share price just today, the contradictions or the conflicts are not as big as they're played out to be. I do think, though, that companies, I'm a little bit worried about the corporate purpose movement, because if you remember back a number of years, we had the mission and vision of companies, which became slogans and didn't really mean anything. I do think that companies need to be very concrete about what it is they're trying to do. We've looked at this and we firmly believe that all the research suggests that long-term value creation leads to higher employment, it leads to better customer satisfaction, et cetera. So there aren't that many contradictions. There are some contradictions in the case of, let's suppose you have a company like Apple and the iPhone. You could argue that a company like Apple, they could lower their prices and shift some of the value from their shareholders to their consumers. But their consumers are happy with their consumers are very loyal. When there is a contradiction like that, where the customers are already happy, doesn't mean you should lower your prices just to lower your returns to shareholders, for example. A lot of companies need to think through. There are some places where there are trade-offs to be made, but for the most part, there's not that much of an inconsistency between satisfying most of your stakeholders and creating value over the longer term.
If I take myself back to the dot-com environment, late 90s, if I look at the last 5, 6, 7 years, we've definitely had a situation where there have been names, companies, very fast growing, arguably unicorns, that probably from a valuation standpoint could not be justified. But on the flip side, if you were just an investor or a trader, Tesla has looked great. Amazon didn't look great for about 10 years, but now Amazon's looked great. How do you feel when you've spent so much time, so much legwork, so much understanding, so much research, so much writing into valuation, and then so many of your clients or associates or whatnot are looking at some of these unicorns take off, and a lot of money is being made, but it's kind of money to be made that you really can't justify necessarily from a valuation perspective?
I think it depends. The market's never going to get it right all the time. There will be some of these unicorns who will fail and some who will be successful. Valuation is not about being able to predict exactly what's going to be happening. In most cases, when you're investing in a company like that, not the very largest ones that are pretty well established now, but the newer ones where they don't have any profits yet, we don't know exactly what's going to happen. Your investment is either going to make a lot of money or you could lose it all. Just because on some of these investments you've made a lot of money, that doesn't mean that that's not going to go away. So the question is, are you going to get out at the right time?
That did sound like a trader there for a second, the way you were describing it.
Well, I was going to say that's true. But if you look at, particularly in the private market right now, it only takes one or two people to push up the valuation far beyond what it should be. You've already seen a lot of those companies come down, a lot of the IPOs being delayed or canceled, or the share price is coming down once they go into the public market. I guess the way we think about it is you need to look to the future and say, how big is the market that they could be in? And what are the economics of that market? And will they have a competitive position? So is this a market that's big enough, the margins are high enough in general, and we're going to have a strong enough market share to be able to attract that value? And if you can't do that, then it's probably not a good investment. I wouldn't take it as a trading point of view. I would take it as, let me understand the long-term potential of this business and then decide which ones are worth taking that risk on and which ones aren't. Something like in the automobile industry, you have to ask the question, okay, in the automobile industry, the history of innovation is that the benefits of innovation have almost always flowed to the consumers because of competition. There's plenty of auto companies and there's new auto companies. First, we had the Japanese coming in, then we had the Koreans, now the Chinese may come in. Lots of competition. So the question is, once things settle down, will someone be able to be so much better that they're going to have substantially higher margins and share than everyone else? I tend to be skeptical about that because competition eventually competes these things away. I think it is harder in some industries than others, particularly in industries that don't have the characteristics almost of a natural monopoly where we have what we call network effects. When you have a search engine company, there's a benefit in the sense that if everybody uses it, then advertisers want to be there. And the more advertisers, the more sort of a virtuous cycle. There are very few businesses like that. So you have to ask the question, is an automobile company, is an office leasing company, do they have those benefits? Or even a ride-sharing company?
I assume you're talking Tesla, WeWork, and Uber?
Yeah, well, without naming names, yes. The question is their business model such that they can keep out the competition? That's the question you need to ask. If you're thinking about a ride-sharing company like Uber, if they eventually try to take advantage of their customers and their drivers, what's to stop local companies starting up who know the market better and provide better service at better prices and those kinds of things? The question is, what are the barriers to entry in some of these businesses? And if they're not that big, in automobiles, eventually everyone may have access to the same technology, which is what traditionally has happened in the automobile industry. Eventually everyone gets access to the same technology, so it's hard to get ahead. You have to ask the question, is this company really going to be special 5 or 10 years from now when you're thinking about valuation?
Your original thinking with valuation, I assume this goes back to Ben Graham, farther back. I mean, what was the original inspiration?
The original inspiration was what we were trying to do was to marry finance theory with how do you actually apply this to the real world. And there were a couple of pioneers who had done that. There was a firm called Stern Stewart, who I worked with before McKinsey, who was a pioneer in applying finance theory to the valuation of companies. Al Rappaport, a professor at Northwestern, also did some work in this area. And that was really the inspiration to say we need a rigorous approach which combines the best thinking of finance theory, economic theory, plus a knowledge of accounting and how do we translate those things, plus strategy thinking. How do we fit all that together to come up with the best things to help companies make better decisions? Our intention with the book, even though the book is called Valuation, it's really the focus is to understand how different things will affect the value of a company. So for a management team, for example, it's not about coming up with a single number. It's about helping them make better choices that will increase value. The inspiration came from people who were trying to translate finance theory into practical stuff. And that's what we were trying to sort of continue on, was build that up together. So you had an integrated thing which crossed all those boundaries that sort of said, okay, here's how you combine strategy and finance and economics and accounting to really have a good sense of the numbers, if you will, of how these things would play out.
You lay this down, the first edition, 1990. My gosh, I have to sit here and we're 30 years later. Wow. In your mind, your original work, obviously you wanted things to be timeless. You didn't want this to be a work that was going to require an ongoing modification. But has there been any kind of modification over that stretch of 30 years? Or do you feel like with a pretty high degree of certainty that you hit the mark and where you want it to be for a timeless work in 1990, and the last 30 years have been updates, but the core has been solid?
That's a perfect way of describing it. The core principles that we talk about in 1990 still are the core principles of the book today. Those fundamentals have not changed. Companies create value through the combination of how high is their return on capital and how fast can they grow the business. Those two factors translate into cash flows, and that drives the value of the company. Short-term earnings doesn't last. Manipulation of earnings by share repurchases, not that share repurchases are bad. I think that they're a good thing for companies that have too much capital that they can't reinvest. But trying to manipulate earnings and stuff like that with share repurchases doesn't create value. Those messages that you should focus on long-term growth and return on capital, and that you shouldn't worry about accounting stuff and financial engineering, so those messages are still the core of the book today as they were 30 years ago. We've learned a lot over 30 years. Part of it is just we've learned better how to communicate these things to our audience as we've practiced what we've been doing. And a lot of it is updating. The accounting rules change. We've added a lot of empirical analysis to back up a lot of the theory. We've updated sections on M&A and divestitures to reflect what's going on in the market today. For example, in the most recent book, in our most recent edition that just came out, we have a chapter on digital. How do you think about digital in the context of valuation? How do you decide how to prioritize digital initiatives? How do you think about them? We also have a chapter on ESG, environmental, social, and governance. How do you think about those and how do they affect value? We are constantly updating in terms of what are the topical issues of the day and more applications of the ideas. The core doesn't stay the same, but we keep on adding more to reflect what's going on in the world right now. Readers like new examples and new statistical analysis. So a lot of it is sometimes just coming up with new examples and things like that that are more relevant.
You know, I'm calling you today from Saigon, a little bit of the Wild West in Asia, crazy economic growth, even in the middle of Corona. I'm sure it's going to take a hit on everybody though. But speak to me about valuation thinking when you start to cross borders. Obviously, America has been the hotbed of valuation thinking. But when we start to look out, are there economies, are there countries where your principles, your valuation principles don't make as much sense? I mean, I know, for example, when I've been in mainland China, you talk to investors, you get through the translation process, and there's a lot of investors there that really only trust the share price because they think everything else is manipulated and not to be trusted. You've really got a trader mentality in merchant China where it's kind of like, hey, I can trust that share price, but everything else, I'm not really sure I can trust it at all.
There are certainly issues when there's not a lot of confidence. That's where the governance side of ESG comes in. If you don't trust the numbers, if you don't trust the governance, et cetera, that will certainly affect the valuation. If you are an executive, though, and I've talked to many executives there, including in mainland China recently, they are concerned that some of their companies there aren't really focused on what really drives value creation. In the number of Asian countries, there's more of a focus on size than there is on return on capital. Size for size sake. There's reluctance to divest businesses that aren't earning an attractive return on capital, to realizing, okay, this business, we're no longer competitive, we should get out of this business, et cetera. There is this focus on stability, growth, size at the expense of profitability.
Is that their way of building a moat, so to speak?
I don't think so, because when I talk to executives over there, I see some of them, especially the CFOs, are concerned about that because they say that's not sustainable.
CFOs are concerned, the CEOs.
Well, and that's why the CFOs are frustrated because they can't always convince the CEOs. And it'll take some time. There'll be a period of time where some of these businesses will crash or they'll just be unsuccessful and then the share price won't go anywhere eventually. Right now, you have situations where China is a little bit different because the government is involved so much in the market and you've got all these retail traders. So the share prices, I remember listening to a speech by an economist who spent all of his career in Asia. And he said, in most emerging markets, eventually the share prices do reflect the fundamentals of the business, except in China right now. China, there's so many other factors that affect the share prices. He would argue the other way around, that the current share price is not necessarily an indicator of what the potential value of that business may be, because it may be influenced by government or retail traders who aren't as sophisticated buying and selling. You really want a market where the share prices are driven by sophisticated institutional investors who spend a lot of time researching and figuring out what a company is worth.
Can I play devil's advocate for a sec? Can I take the Chinese position? Let's say my Chinese friends are listening right now and they're hearing Tim talk. I'm not saying you said this, but I could hear them saying, well, hold on. Okay, yeah, the government's involved in our economy quite a bit, and perhaps our share prices are not so trustable, and perhaps we've got a lot of retail traders in China that are not as experienced. And then they kind of look over to the States and they say, well, my God, how much does the government control the markets in America now after the COVID response? And then they look at Robinhood and all these young retail traders swamping the market. Could other countries around the world be looking at America and saying, hey, what's going on over there, guys?
You could argue that maybe in the short term there are those questions. I think that the US still, though, is the most dynamic, the most innovative economy. One of the reasons why, for example, the stock market has held up so well during the COVID situation is because the stock market has a much larger proportion of innovative tech, pharma, and medical device companies, unlike other markets where we create a lot of value, and we create a lot of value from overseas. So if you look at the different, we still are probably one of the most competitive markets. Whether or not the government has done the best things or not, the good thing is that the economy still tends to operate on the basis of competition, which creates sort of an incentives for innovation, which creates incentives for creative destruction, if you will. Yes, you could look at it and say in the short term, there's some weird things going on, but the economy still works almost regardless of what the government does in many industries. Now, certainly they're going to distort some industries, but in many industries, the economy is still the most dynamic and puts resources where they're best used. And I would argue that I just recently spoke to a very senior executive in mainland China who is concerned that his compatriots, if you will, aren't focused on the right levers of value creation over the long term, the way we are in the US.
So a little more pushback to keep our conversation interesting. We're in March of 2020. We watch US stocks just go bloodbath. And we can all think back to the dot-com crash, and we can think back to the NASDAQ dropping 77%, and we can see, gosh, it took a long period of time to crawl out of that hole. We reached that March 2020 bottom, or whenever it was, early April, whatever, and then all of a sudden, wham, bam, thank you, ma'am. Now, that wham, bam, thank you, ma'am would not have happened without the U.S. Federal Reserve, would it have?
I'm not convinced of that. If you look at the pattern of past sort of crises and how the stock market reacts, the typical pattern is that the stock price, investors tend to overreact and stock prices drop substantially across the board in many cases. And then smart investors come in and they say, well, wait a second here. Look at, not all these companies should have had these big drops. And they start buying and the share prices begin to go back up. If you recall, back in 2009, the S&P 500 temporarily jumped into the 700, I think, area. Then that just brought in a tons of smart investors saying this is way too low. And the stock market began to recover. I think what we're seeing here is just a much faster reaction in the sense that the stock market went down real fast. And then there are enough investors out there saying, well, what happens is the stock market goes down because retail investors panic, endowments and stuff like that sometimes have to sell, trading algorithms push prices down, et cetera. It gets down to the point where smart investors say this is too low relative to long-term fundamentals, and it gets pushed back up. So two things you also need to consider about the current levels of, say, the S&P 500. One is it's not that every stock is down or up by the same amount. There are still obviously stocks that are way down, And there are stocks that have benefited. And it just, on average, we happen to be where we were roughly towards the beginning of the year. But that's almost a coincidence that it's an average of the ones that have gone up versus the ones that have gone down. Secondly, you have to also consider that the stock market is dominated by sectors that aren't as vulnerable in this kind of a situation. For example, the restaurant business, which is being devastated. That's not in the stock market for the most part. Many apparel retailers were already struggling. Their share prices don't have much of an effect on the S&P 500 because they were already struggling and had low share value. So they didn't drive the S&P 500 very much. You have a legitimate disconnect between what's going on in the real economy and what's going on in the stock market, because there are large sectors of the real economy that are not reflected in the stock market. A lot of retail, restaurant, other services, construction, a lot of sectors, professional services, for example. All of these sectors employ lots of people, but they're not in the S&P 500 because they're not publicly traded firms for the most part.
Fair point. Fair point. I guess the follow-up would be beyond what the Fed did, what the U.S. government did in terms of ultimately handing out checks to everybody. If everyone didn't have those checks, they would have had to reach somewhere for money. And you got to figure at some point in time, they would have reached for selling their stocks to get a hold of cash. Again, I'm not having a debate about this. It's just kind of like pointing out the yin and the yang of how this whole process is unfolding. So it's going to be really interesting to see, as you talked about earlier, when it comes time to take the entire country off the Fed dole and the U.S. government dole, what's going to happen?
Well, first of all, we don't know what actions the governments are going to take. We don't know what's going to happen, but there are still big sectors of the economy that are doing okay right now. You have to almost look at it on a sector by sector basis to see what's likely to happen. And there may be a lot of pent up demand that gets released. Companies that have gone bankrupt may reemerge. Restaurants that go bankrupt, the owners may start up a new restaurant or someone else may come in and start up a new restaurant. I think that once that happens, you will see, I guess I'm just an optimist because I'm looking at not only 30 years since I wrote the book, but 10 years prior to that, the formative years of my looking at the economy, the resilience and the ability to respond to all the bad things that have happened since the oil embargo and inflation of the 70s and all the things that we've been through. There is a resilience that we eventually come back. Don't know how long it's going to take, but I'm pretty optimistic that we'll come back.
Great stuff, Tim. I appreciate you taking some time today. The book, Valuation, Measuring and Managing the Value of Companies, 928 pages, if I'm correct. That is a beast. People are going to have to dive in. As you told me, I don't think this is something where you necessarily say, sit down and read it in one bite at the apple. It is more something, reference, pick up, read a chapter, and they can pretty much start anywhere, can't they?
Exactly. I would recommend that you read the first 4 or 5 chapters because they sort of set the stage, and the rest of it, you sort of pick the topics that you're interested in.
Cool stuff. Hey, Tim, where can we send people beyond Amazon to pick up the book? Is there a website you want to drive them to, a page at McKinsey? Where would you like to direct people to?
If you go to McKinsey.com, you just type in McKinsey and Valuation into a search engine, you'll come to our valuation page with the book, which also has other information there, some of the blog posts we've been doing and things like that. That's one place you can go if you want more information. You can also see, if you go to the McKinsey Twitter and LinkedIn feeds, you'll find a number of things that we've written about the book recently, shorter bites that might be intriguing to listeners.
Took us a little while to finally connect, but cool stuff. I appreciate you taking the time.
I enjoyed it. Thank you so much. I enjoyed the challenges.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government, and trust Wall Street, this is absolutely not for you.